Brad Williams, Frugal Finance. Let's talk a little bit about mortgage. The question, what is mortgage insurance and how does it work? Mortgage insurance lowers the risk to the lender of making a loan to you so you can qualify for a loan that you might not otherwise be able to get. In other words, you don't have 20% down. The lender is going to want some protection against default on your part. So they're going to hit you with mortgage insurance. Typically, borrowers making a down payment of less than 20% of the purchase price of the home need to pay for mortgage insurance. Mortgage insurance also is typically required on FHA, USDA, and Fannie Freddie type loans. Mortgage insurance lowers the risk to the lender of making a loan to you so you can qualify for a loan that you might not otherwise be able to get. But it increases the cost of your loan. If you're required to pay mortgage insurance, it is included in your total monthly payment that you make to your lender, your cost at closing, or both. Now be careful here. Do not add a chunk, a large lump sum amount in the way of mortgage insurance at closing. Do a prorated monthly amount. The reason being, if you were to pay a large lump sum of mortgage insurance, similar to what FHA requires, you're not going to get that back if you happen to sell your house within 2 to 3 years. Does mortgage insurance protect the lender or the borrower? Mortgage insurance, no matter what kind, protects the lender, not you, in the event that you fall behind on your payments. If you fall behind, your credit score could suffer and you could lose your home through foreclosure. Then, in the worst case scenario, supposing your property is sold through foreclosure and the sale is not enough to cover your mortgage balance in full, mortgage insurance makes up the difference so that the company that holds your mortgage is repaid the full amount. There are several different kinds of loans available to borrow with low down payments. Depending on what kind of loan you get, you'll pay for mortgage insurance in different ways. Loan types in mortgage insurance: conventional loan. If you get a conventional loan, your lender could arrange for mortgage insurance with a private company. Private mortgage insurance, PMI, rates vary by down payment, amount, and credit score, but are generally cheaper than FHA rates for borrowers with good credit. Most private mortgage insurance is paid monthly with little or no initial payment required at closing. Under certain circumstances, you can cancel your PMI. Generally, when your loan to value drops below 80%, you can request or demand that PMI be dropped. Federal Housing Administration, FHA loans. If you get an FHA loan, your mortgage insurance premiums are paid to the FHA. FHA mortgage insurance is required for all FHA loans. It costs the same no matter your credit score, with only a slight increase in price for down payments less than 5%. FHA mortgage insurance includes both an upfront cost paid as part of your closing cost and a monthly cost included in your monthly payment. If you don't have enough cash on hand to pay the upfront fee, you're allowed to roll the fee into your mortgage instead of paying it out of pocket. If you do this, your loan amount and the overall cost of your loan increases. USDA, these are rural loans. If you get a USDA loan, the program is similar to FHA, but typically cheaper. You pay for the insurance both at closing and as part of your monthly payment. Like with FHA loans, you can roll the upfront portion of the insurance premium into your mortgage instead of paying it out of pocket, but doing so increases both your loan amount and your overall cost. VA loans. If you get a Department of Veterans Affairs backed loan, the VA guarantee replaces mortgage insurance and functions similarly. With VA-backed loans, which are loans intended to help service members, veterans, and their families, there's no monthly mortgage insurance premium. However, you pay an upfront funding fee. The amount of that fee varies based on your type of military service, your down payment amount, your disability status, whether you're buying a home or refinancing, whether this is your first VA loan or you've had a VA loan before. Like with FHA and USDA loans, you can roll the upfront fees into your mortgage instead of paying it out of pocket, but doing so increases both your loan amount and your overall cost. Beware of piggyback seconds. I don't know about the word beware. Sometimes it's the only alternative, and yeah, it could be a little bit expensive, but perhaps, and you have to do some math here, If you can get a second that doesn't require mortgage insurance, perhaps it's cheaper in the long run to have a piggyback second. If you have any questions regarding seconds, check out my YouTube video playlist, Mortgage for Seconds. As an alternative to mortgage insurance, some lenders may offer what is known as a piggyback second mortgage. This option may be marketed as being cheaper, but that doesn't necessarily mean it. Always compare the total cost before making a final decision. How to get help? Well, in this day and age, here we are, March of 2025. You're going to be on your own. You're going to have to deal directly with the lender. Or worst case scenario, you may need to hire an attorney in order to fight a lender or a mortgage insurance company or an escrow company, because this information is provided by CFPB and they're no longer available to help you, the consumer, with problems. So comment if you have any questions related to mortgage insurance, mortgages, lending, down payments, first-time home buying. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.